So welcome everyone. This is a FAR review session. As you know, we're going to cover today two topics that seem to come up on every FAR exam, either in the form of a simulation or multiple choice, even multiple choices, okay? And one subject's very complex, right? That's the investment one, which we're going to spend most of the time on. And then another one is on bank reconciliations. And after I finish bank reconciliations, I'm going to send you by email another one I want you to do on your own. And I'll send you another file with the solutions. And let's see how good you do on the bank reconciliation. So even bank reconciliations come up on the CPA exam. It's amazing how many people have told me they've gotten that as a sim or a mobile choice. Okay, so I'm starting today on investments. I want the same level of participation, please, as yesterday. It was wonderful. Don't be afraid to stop me with questions. You know, we don't have 50 people here, right? We have 7. Perfect. And any questions, put on your mic and don't be afraid to answer them. I'm on page 2, E as in Edward, -1. 2, E as in Edward, -1. That's where the investment starts. And just for the sakes of the video, investments is covered on 2E-1 through 2E-18. And the bank reconciliations are covered on pages 2A-1 to 2A-5. Okay, so that's what we're going to be covering in this live, soon to be recorded session. So investments is a really important topic for the exam. Reason is, right, companies like Apple have like $500 billion of money in the bank, okay, and they invest it. So does Microsoft. All the tech companies, right, are cash flush and they make investments, okay? They buy bonds, they buy common stock of other companies, and they make equity investments in other companies. So this is an important topic, okay, in accounting, even for small businesses, just important. So the accounting treatment, right, of a company's investment in equities is determined by quite a number of different factors, okay? So to start, we're going to go through in detail the investments in debt securities and equity securities, okay? So an investment in a debt security is investing in something like a corporate bond, right? Convertible debt, commercial paper, redeemable preferred stock, municipal securities, and U.S. government agency securities. Those are part of the group called debt securities. Then equity securities, that's easy, right? You're investing generally in the common stock of another company, okay? Or the right to acquire common stock ownership in that company. So when you're thinking about investments, distinguish in your mind between debt and equity, okay? The other two factors, and this is what drives the accounting treatment of them, is what is the investor's intent to hold those investments, okay? All right. And what is the percentage of ownership that they have as a result of that investment, especially for common stock investments, all right? So as we describe each investment, I want you to refer to the chart flow. So when you're getting ready to take FAR, I want you to go to the next page, make a copy of it, and that will be your final summary to study for investments. And if you know the next page, you are golden, okay? Now, this stuff in the hint area, I'm gonna come back to it after I review the accounting for it. So can you please remind me to come back to this hint box? These are some of the most recent updates for the accounting for investments, but I'd rather go through the basics first before I get to the updates, okay? So please turn to 2E2, and I give Phil complete credit for this. He's the one that designed this, okay? This is the Bible for investments, I call it, okay? The accounting for investments, all right? And it's all been updated for any changes in GAAP in recent years. So let's go through this. If you're making an investment in a debt security like bonds, okay, when you make that investment, it could be 0 or 100% of the bonds outstanding. The classification is based on what is your intent on holding them. Are you going to hold the bonds until they mature? That's called a long-term investment. That makes sense, right?
Yeah.
Yeah.
Are you buying them because you can think you're going to make a quick amount of money on them, hopefully, a quick profit on them, okay? That's called a trading security. That's a short-term classification. And then available for sale means it's somewhere in between. You're not committing to say you're going to hold it till the bond matures, and you're also not saying you're going to trade it in the short term in the next 12 months. So that's called available for sale. All right. Please stop me if any of this is confusing. All right. So for investments in bonds, debt securities, on the balance sheet, how do you present them? Well, if your intent is to hold those bonds until they mature, you record them on the books at their amortized cost. Okay. So if you paid a discount or a premium when you buy them, right? You remember your bond accounting, right? You do premium amortization, you do discount amortization. It gets recorded on the balance sheet at cost. No reflection whatsoever from market value, okay? Since you're going to hold it to maturity, Carlene, that means theoretically, at least, when it matures, Carlene, you're going to get the face value of the bond back. Therefore, there's no such thing, even though the bond price may be going up and down while you hold it, there's no such thing as an unrealized gain or loss on a bond because you're holding it to maturity. That makes sense to me, okay? Now, while you hold the bond, of
Can I
course,
stop you?
sure.
No? Okay, so you said on the balance sheet you carry it at the cost. So you have the bonds, the face value is 400,000, but you bought it at a discount. So I don't know, you bought it
You bought it at 95 cents, right?
95, yeah.
Yep.
So on the balance sheet, you put the face value, you put 100,000, but the up and down.
No. I mean, you paid. Okay, so it's $100,000 face value bond, but you bought it for 95.
Right.
Okay, debit investment 95.
Okay.
And
Okay.
credit cash 95. Okay, that's for sure, right?
All right. All right.
Now, there's a $5,000 discount because you
Right.
know the face value of the bonds is 100,000.
Yeah.
So now each accounting period under GAAP, you will amortize the bond discount, right?
Okay. Okay.
So you're going to debit what?
You debit, so you want to increase the value, so you
Of the investment, debit the investment,
debit the
right?
investment
And credit.
Credit, is that the discount, bond at a discount? I haven't done that in a while. Debit
Anybody know?
the
What
liability.
happens when you amortize a bond discount? What's the entry? Cheryl, I can't hear you.
You debit discount and credit investment.
Investment, is that?
No, why would you credit the investment? That brings it down. You're going to take the $95,000 investment and it's going to be amortized up to 100, right? At maturity. So don't you debit investment,
And
right?
you get what, the discount?
And credit, yes, and credit discount or
Discount.
credit, actually interest expense, right? Or interest,
Okay. Okay.
right? Because you want the carrying value of that bond when it matures to be on your books at 100, right?
Right. Right.
So you're going to amortize it the entire time you hold the bond. Okay.
Okay. Thank you.
Very good question. Now, obviously, you know that bonds don't pay dividends. Don't be fooled on the exam, right? They only pay interest. Okay. So don't forget that. That's why Phil put that in there. Now, if you're going to hold the bonds on the short-term basis, everything changes. Everything. So on the balance sheet, you must record it at fair value. And we're going to talk later about what happens if you can't find a fair value or there's no published fair value. What do you do? But let's assume for simplicity's sake, you can get a fair value, okay? So you record it at fair value. Any unrealized gain or loss, right? Because that's unrealized, right? If the value of the bond goes up, it's unrealized gain, right? If the value of the bond goes down, it's unrealized loss. That goes to the income statement. Okay?
Okay.
Because the
I'm
intent
sorry.
is to hold it short term.
So earlier you said that there is no unrealized gains and losses for bonds. So I need clarification on the entries of the
Okay. So we said there's no unrealized only in the case where you're going to hold the bond until it matures.
Mhm.
That's 5 years from now, 10 years. You know, most bonds have very long lives, right? 3 years, 5 years, 10 years. So there's no such thing as an unrealized gain or loss on bonds that you're going to hold till their maturity in the future. And that makes sense because if you did book gains or losses, they're not going to be realized until 5, 10, 20 years from now. GAAP does not like companies recording, right? Unrealized gains or losses that are going to happen 10 or 20 years from now. Okay.
Right.
They don't like that.
Mhm.
Okay. But in the case of a short term, you're
Mhm.
telling the market, I bought this bond and I'm going to sell it in the next 12 months.
Mhm.
Well, that's a short-term security. Okay. You've bought it for a reason, either to make a profit and hopefully not get a loss. Okay. So any unrealized gain or loss in that case goes to the income statement.
I see. Mhm.
Got it?
Yeah.
So what drives all of this? The intent, right?
Mhm.
The intent. When
Mhm.
you're looking at your exam questions, you got to look at what kind of security is it and what's the intent. Okay.
Mhm.
Next, available for sale. So that's somewhere between I'm going to hold it to the end, long term, or I'm going to hold it only for the short term. So in those cases, the good news is, right, it's still going to be recorded at fair value, but because it's not short term, you know, it's somewhere between short and long term, any unrealized gains or losses, we saw that yesterday, go to AOCI, right? Other comprehensive income. Okay. All right. This chart is very valuable. Okay. There's going to be some things as you're studying for exam. I remember when I studied, there were a couple charts in the books I always put off to the side. I said, I'm going into the exam and I'm going to know this cold. If I get a question here, I'm going to get it right quickly and move on, okay, to the other stuff that perhaps I don't know. All right. So everybody okay with bonds?
Yeah.
All right. Let's move to stocks. And of course, that's much more complicated. Now, if you or your company makes an equity investment, right, buying common stock in another company, and you own somewhere between less than 20% of the outstanding common stock of that company, okay? And that common stock has a readily determinable fair value, right? It's quoted on the stock exchange, or you can get a fair value from it somewhere, right? That's correct. It gets recorded on the balance sheet at fair value. Any gain, unrealized gain or loss goes to the income statement.
Thank you for previewing the Yaeger CPA Review course materials. To learn more or to purchase the full course, visit YaegerCPAReview.com or click the link in the description.